This is your guide to depreciation, covering everything you need to know about this very helpful tax deduction. Depreciation can help you boost your property's cash flow and nudge it from negatively geared to positive. So how does it work? Your Investment Property Magazine editor Sarah Megginson sat down with Tyron Hyde, Director of Washington Brown Quantity Surveyors, to uncover everything you need to know about depreciation.
So what is depreciation? Well, just like you can claim the wear and tear of a computer against your taxable income for a business, you as a property investor can claim the wear and tear of a property investment against your taxable income. So how does depreciation work? Well, you as a property investor, you need to engage a quantity surveyor to go out to a property and we work out what things cost to build. We break down the construction cost of a property into things like bricks and concrete and ovens and dishwashers, and we give you a report that itemises those costs and how much you can claim for each of those items. You then get a depreciation schedule, which you give to your accountant, and he claims how much we say you can claim in the relevant year. So what that means is, if we say in the year 2020 you can claim $5,000, that'll come off your taxable income. And if you're on the highest marginal rate of say 47%, that means that you'll get a net return of say $2,400. So a depreciation schedule is a really worthwhile investment. Well, the depreciation cost varies, but let's say residential property. It'll vary from say $440 to $770. And the things that make that vary are where the property is. For instance, if the property is in Kalgoorlie, it might cost more than if it's in Sydney. If the property is a 5-bedroom home, it might cost more than a 1-bedroom studio apartment. Is it tax deductible? Absolutely. A depreciation schedule helps you manage your cash flow because it reduces your taxable income. And the good news is about a depreciation schedule, the depreciation's already within the property. Every other deduction that you get, you've actually got to either sign a check or be paid or direct debit it. However, a depreciation schedule or the depreciation is in the property when you buy it. You as a property investor just need to know how to work out how much you can claim. And that's where a quantity surveyor comes into play. So why you need a quantity surveyor to work out the construction costs was that in 1997 the tax office put out a ruling called TR 97/25, and that identified quantity surveyors as being the appropriate body to estimate the costs where the costs are unknown of construction. And you as a property investor claim the existing construction costs or the original construction costs. Now that information is not often passed on. That's where you engage a quantity surveyor to work that out. The ruling also identified that accountants can't claim that accountants can't work out those original costs, nor can property managers or real estate agents. Don't fret if you've bought a property 2 years ago and you're watching these videos and you've just said, I should get a depreciation schedule. The good news is we go back to when you actually bought the property and work out the deductions back then. You can then amend your tax returns for at least 2 years in order for you to backdate your claim. So don't fret. So how much can you claim depreciation? Well, I actually just wrote an article for Your Investment Property Magazine on this exact topic. And what I worked out is you can divide a property into 3 different types, okay? So to give you a generic view of how much you can claim. So if you were to buy a property that was built between 1987 and the year 2000, you could roughly claim about $4,000 in the first year and $40,000 over the first 10 years. If the property was built between the year 2000 and the year 2018, you could claim roughly $6,000 in the first year and $60,000 over a 10-year period. If the property is brand new, it might elevate to $15,000 in the first year and about $90,000 over a 10-year period. You really need to work out what it is for your specific property, but that gives you an indication of how much you can claim. And I'll use a 10-year figure, but that will vary depending upon the age of the property. Because when a property is brand new, you can claim the building allowance for 40 years, which means if you buy a property that's 20 years old, you've got 20 years left. I just use 10 years to give you a generic view of how much you can claim.